Buy stocks like you're buying a business. This means that you should think of it as you own the stock for a long time, and therefore you're valuing the business according to its expected results, and not according to what people might want to pay for a stock a week or a month from today. A good way to remember this is to think whether you still want to buy a stock if they were close to close the stock market for 5 years after you bought it. Stay within your circle of competence. You should stick to what you know. You can't value a business if you can't predict something about the competitive dynamics of an industry and its own place within it. It's not about having a large circle of competence, but about knowing where its boundaries is and staying within it. You can do well if you only understand 20 companies in the world, as long as you stick to those 20. Insist on a margin of safety. The world is messy and you'll make mistakes. You should always make sure you buy investments when they are selling way below the estimate of their worth. While this means you may need to wait a while, it will minimize potential losses, which connects with the next principle. Never lose money. Buffett is more focused on not making mistakes than on getting big winners. He is always willing to say no, and you should be too, whether it's because a business isn't within your circle of competence or the margin of safety isn't large enough. It's better to say no than to suffer a permanent loss of capital. Price is what you pay, value is what you get. Never confuse price with value. The price is the easiest thing in the world to figure out. It's reported every second everywhere. The value is the hard part. And what you should focus on how much free cash flow will this business produce in the next 10 years. How sure are you of the estimate? These are all the questions to focus on. Don't even look at the price chart until you think you can answer that.